Jahangir Aziz, Chief Economist for India at JP Morgan, joins us on the show. Jahangir, morning. Thank you for joining us. Jahangir, FY13 GDP or FY13 GDP was at 5%, which is the lowest in a decade, and for Q4 it was at 4.8%, which is again weak. Agri clearly is below trend and the slowdown continues. Does the GDP disappoint you, and what are your thoughts on the big picture?
I think much of this was known, that we would be coming up with a pretty low GDP growth number. So I think in that sense, the fourth quarter number per se did not disappoint. Clearly, the fact that we have a 5% growth rate is very disappointing. But I think there are still some signs that things aren't as bad as they appear. The 4.8% fourth quarter growth rate compared to the third quarter of 4.7 gives a sense that the economy has bottomed out and is stabilizing. But more importantly, if you look at the quarterly momentum, then that clearly suggests that the bottoming out did take place in the second quarter of the last fiscal year. And in the last two quarters, we have seen some decent recovery. And I think that bodes well. Does that change India's growth trajectory from the 5-6% back to the old numbers? Unlikely.
Jahangir, the GDP momentum continues to be slow. Looking at today's data, is there any case for you to revise your FY14 GDP estimate downwards, and what will be the drivers for the FY14 GDP according to you?
We have always been on one end of the spectrum. So for the last 6 months, we've had a growth rate for FY14 around 5.7%. We were very gratified that Reserve Bank in its revised estimates has also come to our level of 5.7%. The government remains significantly above that. But the consensus, which again, a few months back was running around 6.5%, seems to be coming down to levels below 6%. So at this point, we are pretty comfortable with a 5.7% growth number. We would be revising it, but that would depend upon how the second half of this calendar year's growth in advanced countries such as US and Europe pan out.
So, Jahangir, how would you view the FY13 fiscal deficit figure?
The news reports suggest that it's going to be around 4.9%, and that's stunning results by any standards. I mean, it's not only below the 5.2% preliminary estimates in the budget speech that the finance minister gave, but it's actually even lower than last year's budgeted 5.1%. What is actually far more stunning is the fact that, not too long ago, back in September, before the new finance minister took over, most of us were very scared that this fiscal deficit number could reach as high as 6%. So I think it's been a very, very sharp turnaround, and all kudos to the new economic management team in Delhi. However, the manner in which this was achieved, which was by squeezing expenditure completely, I think that has had a toll on the economy. We've seen government spending being squeezed very, very sharply in the last two quarters of the fiscal year. And if you look at GDP growth rate actually has seen a significant weakness coming from that. So I think the economy has paid a price for it. But I think as far as the financial market and financial conditions are concerned, that clearly has been boosted by the fact that the government has managed to deliver a very positively surprising deficit outturn.
So given the fuel price hikes and steps taken towards fiscal consolidation, how confident are you, Jahangir, on the government meeting the 4.8% fiscal deficit target?
Sure. I think the 4.8% target seems achievable. I know there have been a lot of concerns that this is election year and you would probably see election year related spending taking place. But so far the government has shown remarkable resilience and remarkable constraint, and they haven't gone down that route. My guess is that this particular economic management team in Delhi actually wants to meet the 4.8% deficit target, and I think they will, managed to do that. Perhaps not the way in which it is envisaged in the budget. I think what you might get to see is lower revenue coming from the lower growth rate. But at the same time, that would be compensated by similar kind of constraint on expenditure, despite the fact that this is an election year. I think what has been clearly positive over the last couple of months is the fact that one had seen diesel price hike, the monthly diesel price hike stopped coincidentally around the Karnataka elections. But once the elections are over, it was very good to see those diesel price hikes again back on. And therefore, I think the government really has shown a commitment to continuing with the diesel price increases in order to keep the fiscal deficit contained at that 4.8% level.
So given the recent data flow on GDP and steps taken by the government on fiscal consolidation, how serious is the risk of rating downgrade for India?
Look, I mean, one had expected, or at least the government and parts of the market had expected, that S&P in its most recent review in the last few weeks would strike a positive tone. S&P did not. And S&P continued to say that given the fact that reforms haven't been continued, the reform process has slowed. So despite the fact that the government did manage to achieve this 4.9% fiscal deficit target again, which is a stunning result given the fears that one had back in the second half of last year, my guess is that India is not out of danger. And I think that unless there is something spectacular that happens in the current account side, the current account deficit has remained a key weakness, continues to be a key weakness. I think that, the threat of a downgrade, even though the market isn't really focusing on it, that threat of the downgrade remains alive. And however, I don't think S&P is going to pull the trigger before the May 2014 elections, giving the new government a chance to show what it is likely to do.
Right, so concerns continue, Jahangir, on the trade deficit and current account deficit front as well. With the fall in gold and oil prices, how do you view now the trade deficit as well as the data's shaping up?
Again, I mean that, the first quarter was a surprising, positive surprise. First quarter we saw trade deficit shrink very sharply, and our estimates suggest that the current account deficit, which reached 6.7% of GDP in fourth quarter of 2012, probably fell very sharply to around 3.5% of GDP in the first quarter of this year. However, the last 2 months, we've seen trade deficit back to the 17-18 billion monthly levels. And that clearly does not bode well for the current account deficit for this quarter and going forward. What is more concerning is the fact that the rupee has remained under pressure in the last month or so. Some of it, of course, has to do with the fact that there are concerns in the U.S. Treasury markets, and that has led to a sell-off in U.S. Treasuries, and that clearly has had some impact. Bank of Japan's quantitative easing has also had an impact. Having said all of that, my guess is that the fact that the rupee remains weak and is weakening suggests that the trade deficit numbers in the last 2 months are going to be as bad as in April.
So finally, rupee volatility and weakness continues largely because of strength in dollar. That is the consensus view. So do you see a rupee falling below 57 to the USD? And what are the implications of a weak rupee on India's macro fundamentals?
I mean, over the years, I'm going back 30 years, all macroeconomic problems in India have always found its manifestation in a weak current account deficit and weak rupee. Whether that's a fiscal problem or it's growth related or inflation related, at the end of the day, that's one variable where everything is essentially reflected. And I think that's essentially what's happening. I think the weakness in the rupee continues to suggest that the economy remains weak. Even though inflation seems to have come down, inflationary concerns remain. And as long as that differential remains large, weakness in the rupee will continue. Whether that gets, in a sense, it is getting reflected in large and widening trade deficit numbers. It is getting reflected in slowdown in capital inflows. But at the end of the day, it is the key benchmark that, or the key bellwether variable that tells us that the macroeconomy in India is actually it remains pretty uncertain, remains very fragile. And I think more than what impact the rupee has on the macroeconomy, I think the rupee is the variable that tells us that the macroeconomy remains very fragile and uncertain.
Jahangir, good chatting with you. Really appreciate you taking the time out and joining us today.